What's up, guys? It's Cash Flow Cart. Today, we are doing the December dividend income portfolio update. It's Monday night. It's December 4th. Um, Definitely feels like a Monday, but I wanted to film this. So, you can see I'll be using the TD Ameritrade income estimator tool. And, that brings me to a quick point. I see a lot of other YouTubers pushing their fancy software, their spreadsheets, for tracking your dividends, for, seeing all your sector breakdown. If you want my honest opinion, as you go along in this game, you'll realize that, some sort of fancy tool like that is not super necessary. Depending on what broker you use, they'll probably have, tools that work seamlessly, with your account. So again, I don't know why, but let's not waste too much time on that. So as you can see in December, it says here $79 estimated annual income, but there's already been one payment from Pfizer of $62. So for December 2023, I should make $138.20 in total, for the overall year, the next calendar year from today. My estimated annual income is $2,174. That breaks down to $181 a month on average. And then, the average dividend yield of this portfolio, I guess, is, 4.1%. And they're just taking that by, the estimated annual income divided by the total market value right now. This isn't like a yield on cost number, but I guess it's still interesting. Okay, so let's get into some of the positions. We'll start by looking at my biggest position down to my smaller positions. The biggest position is Apple, and then Realty Income, Altria Group, Microsoft, Starbucks, Pfizer, T. Rowe Price, and then Coke. And, I think one of the things that kind of sets me apart from a lot of other YouTubers is I feel that a lot of YouTubers nowadays, or not just YouTubers, but a lot of dividend investors in general, they've committed to this dividend investing strategy. I guess they believe in it. Maybe they've ran some compound interest calculator stuff on the web or whatever they've done. But they don't really have that hunger to pick undervalued stocks, to commit to them. Instead, they're more just spreading out their capital amongst a lot of dividend paying positions. Excuse me. And I'll see they'll make these type of videos, and account value aside, they'll have 20, 30 positions. And I'm like, here's my take on that. If you're going to, use so many different positions and just have all these different ideas that you're putting money in with no real rhyme or reason, you just want, diversification for the sake of it, you're almost better off just using a low expense ratio ETF. Because if you're going to stock pick, that's one thing. But, if you're going to be successful with stock picking, you're going to have some conviction in your best ideas. You're going to have to put your money, I guess, where your mouth is. And, when you see stuff that's undervalued, you need to focus on building out a position and, in those plays. So, sorry for the rant, but like I said, you'll see here in this almost $55,000 account, there's eight positions. And then I wouldn't even say eight. I would say really six, because these two at the bottom are still in their very early, stages of getting built out. I would consider these prepubescent. I would consider these baby positions. T. Rowe Price is one I'm having a hard time with because I'm very interested in the fundamentals. The dividend metrics are like very attractive. You know, we've seen an uptrend of, the top line. Also, they have more cash on hand than debt. It's like, but then on the other hand, a part of me is just nervous around owning something in the financial services industry. And, I guess that could come from my background working as a financial advising assistant. Um, I was never too impressed with any of the T Row funds. So, we've all got our own biases. I guess we have to work through them or simply not invest in these companies. But this is another tangent. So we looked at the market value. We'll look at the estimated annual income. Altria, that position's nearing $1,000 in estimated annual income, which is awesome. But on the other side of that coin, my estimated annual income is roughly 2,000. The estimated annual income from this one position is roughly 1,000. So it's like half my income in one position. And like, although Altria does look like a pretty good buying opportunity to me right now, I have to ask myself, okay, now I've got this risk of concentration in my income. So if something happens, if something tragic happens to Altria Group, knock on wood, um, you know, it's a matter of a big chunk of my income is in that stock. These are nuances and these are kind of decisions and I guess internal battles you're going to face along the way. Realty income, $660 estimated annual income. Obviously, that's a monthly payer, so that's $55 a month or something like that. Yeah, 55 a month. Next up, Pfizer. This is a relatively new position, and I might show like the cost basis on some of these positions, but I don't have the best cost basis on this one because I've been buying it just recently, but it's even though it's been down and in my opinion undervalued, it's continued to fall. Okay, so that's another thing. You're going to be tested as a dividend investor. You might find a stock that looks attractive to you at the current valuation, and then you start your position, but it keeps falling. And some investors, especially newer on in the game, they're going to be like, oh my God, what am I doing wrong? So, you got to have conviction in your stocks. And if you're buying Pfizer at, let's say, $36, and then it falls to $29 or $30, as a dividend oriented investor, what that is an opportunity. That is not, oh, I made a big mistake. That is, let's get the cost basis down. Let's lock in more shares at a higher starting yield. And, let's see what happens from there. Next up, Starbucks. I like Starbucks a lot as a stock, but I am very content with it being like a medium-sized position just because, they've got it's a coffee business with a moat, which is pretty impressive. However, even though it has this wide moat and it has a very addictive property as Starbucks. I mean, I do have fears of like maybe kind of the casual customers would, they'd cut Starbucks out of their weekly or monthly expenses, whatever it is. So for that reason, I like Starbucks, especially at the price I got it at, but it's going to stay as a medium position. Apple is paying me $61 or $60.50 as my biggest position. So, I really like my cost basis on this one. It's like 117 a share, which we can look at in a second. But for me, with Apple being the biggest position right now and seeing how much, Apple and Microsoft have both ran up this year, I'm kind of in the same boat with both of these. I'm not selling. I'm not taking profits. I'm enjoying my cost basis. I'm watching, hopefully dividend increases year after year. And, for now, Apple's going to stay as a large position. Microsoft's going to stay as a medium to large position, both paying about 60. T. Rowe Price, I went over this one. You go on Seeking Alpha, look at T. Rowe Price. It seems like a great buy, just from a fundamental metrics perspective. Um, I think the yield's been as high as 5% when it dropped under 100 a share. So, I've been nibbling at this one, but I kind of got some barriers I got to break down mentally before I can build this position out to be, a respectable part of my portfolio. Nevertheless, it's paying me $24 in annual income. And then Coke is like one of the companies with the widest moat, the widest economic moat, imaginable. However, for that reason, and for its long track record of dividend increases, for its great margins, it trades at a premium. And, although I do see Coke is, trading at more of an undervaluation than it has been historically right now, it's like I feel like I'm not getting ideal entries on Coke, so I'm kind of like slowly building this one out, kind of feeling it out, testing the waters, I guess. You know, Coke, if we saw like any sort of real dip or, broader market pullback, recession, anything, Coke is one that I'd be like, I would build into it big, if not biggest position in the portfolio, but we'll just have to wait and see. Okay, so there are, the 8 investments in my portfolio. And, real quick, I said we'd look at a few cost basis things. We're not going to spend all day on this, but okay, here's Apple. I guess we'll start with it. So my average price on Apple, $117 a share. You can see the trades on here. Dating back to, I guess, 2019, started buying a little bit of Apple, I guess traded out of it for some reason. But yeah, this one's a long-term hold. And you'll see some sells, but I don't know. I guess that's rebalancing along the lifespan of this account. For now, with where I'm at now as a dividend investor, ideally I never sell. Okay. I mean, there's going to be special cases. Maybe I like, maybe I'm in one of these smaller things like, for example, T Row. If I'm starting to build a position and I decide it's not really for me, I take it off. But, with where I'm at in a perfect world, I'm never going to sell, out of any of these positions. I'm just going to build them. I'm going to add new positions with new capital and reinvested dividends. Okay, moving on. Coke. This one's very new. So let's see. $56 a share. I'm up $2 a share on 7 shares. So that's nothing to write home about. Altria, $44 a share. You see I've built this position out, over years. And that brings me to a good point. Like, part of the reason I've been able to keep, such a lean portfolio of concentrated positions that I have conviction in that are going to be great performers in terms of dividend and dividend growth. And part of the reason I've been able to keep like so limited positions is because, it takes time. It takes time to build out these positions. And if you have a high conviction in a stock and you see it as undervalued, it might take you, 6 months, a year, 2 years plus. You can see I've even added to Altria as it, decided to continue kind of this wedge pattern. But I think the main problem beginners have is like, okay, I'm going to buy a couple shares of SCHD next week. What am I buying? Okay, week after that, what am I buying? Month after that, what am I buying? They don't really have like, I guess, the discipline to keep a